Chapter 1, a brief overview of accounting. Today we're going to talk about, in the abstract, what it is that accountants do, what the output of the accounting process is, and the environment in which it is developed. Let's talk about investing for a moment first, though. What are our options if we're looking to do the responsible thing and we want to set some money aside for our dotage? What are the options that we typically think of when we're talking about investing? 401ks, mutual funds, stocks, bonds, those sorts of things. Regardless, we are entrusting our money to another to use and earn us a return. Either we're going to loan them some money, that's a bond, or we're going to receive an ownership stake in the firm in return for our money, that's an equity investment or common stock. So the question becomes, how do we know which company we should be investing in? There are a number of steps we might plan on taking first, picking an industry for instance, plastics, or picking a part of the world that you think is primed for financial success. However, once we've got an idea about where in general we would like to place our money, we're eventually going to have to make a choice. So here's what I've done. I've provided on the next slide and on the first page of your Chapter 1 packet 2 sets of financial statements for you to look at. Both of these companies operate in the same part of the world, in the same industry, and we get to pick which of the 2 we want to entrust our money to. Pause the recording and take a few minutes to come to a decision. There's only a limited amount of data here, so it shouldn't take you too long. When you're finished looking at the financial statements, resume play of the video. Okay, so you've made your decision about which of these 2 firms you'd like to invest in. So what are the differences between them on which we would make our decision? Probably first and foremost, there's the difference in their operational results. Firm 2 earned a positive net income, whereas Firm 1 earned a net loss. And if we were to look at the detail on the income statement, in particular the relationship between sales and what the firm paid for what they sold, Firm 2 seemed to do a better job there too. That is, both firms reported sales of $115, but it only cost Firm 2 $50 to earn it, whereas it cost Firm 1 $70 to earn the same amount. Additionally, Firm 2 has more assets on hand, driven by inventory, and while it has more liabilities, it also has more owner's equity, which is the owner's claim on the assets of the firm. By pretty much any way we wanted to look at this data, Firm 2 is clearly superior to Firm 1. In every class I've used this example, that has been the resounding winner. Now, it should probably come as no surprise to hear that that's actually wrong. And this is for a number of reasons. First, of course, this wouldn't be a particularly good example if things were that obvious. And it wouldn't provide a compelling reason for you to learn the material in this class, so there must be more to it than that. Now, the truth is that not only is Firm 2 not the better firm than Firm 1, Firm 2 is actually the same as Firm 1. Firm 1 and Firm 2 are not only in the same industry, but they are the same company who bought and sold the same stuff for the same prices from the same suppliers and to the same customers. When I set up this example, the only thing I manipulated between Firm 1 and Firm 2 was a single accounting rule related to inventory. And when I say manipulated, I don't mean in a mwahaha sort of way. Within U.S. accounting rules, there are a number of options that are completely legal, completely legitimate, but yield quite different financial statement results. Specifically, what I did was this. The company purchased 3 units of inventory, one at 20, one at 30, and one at 40. It then sold 2 of those units for $115. The accounting choice relates to the assumption about which items they sold. So you can probably see even now that we'll have a different set of results if we say we sold these 2 boxes, as opposed to if we say we sold these 2 boxes. And so let's take another look at Firm 2, which reported that profit. Firm 2 chose to assume that they sold the 2 cheaper units of inventory. This yielded the $50 cost of goods sold on their income statement and the ending inventory of $40. Take a look at Firm 1, which reported that loss. They chose to assume the 2 more costly items were sold. There's our $70 cost of goods sold and our $20 ending inventory. So they reported both lower inventory and a loss from operations. Now, it is very important for this point to be clear. How many boxes of inventory does the firm have in its warehouse? Only 1. How much did it get paid for the 2 boxes it sold? $115. The accounting choice didn't change those realities at all. It simply changes the way we report about reality. Of course, you may be thinking to yourself now, well, if the two companies are the same, why did you tell me that choosing firm 2 was the wrong choice? And the answer is because even though these two companies bought and sold the same things throughout the year, firm 2 is actually in worse financial condition than firm 1. And the reason for that is in that first number that you likely clued in on when choosing between the two. Net income. What do companies have to do with their net income every year? Pay taxes. Companies that lose money, on the other hand, don't have to pay taxes. At least not yet. I hear they're working on it in Washington now. So, again, to recap, we have two companies that bought and sold the exact same stuff for the exact same prices. They each spent $90 for 3 pieces of inventory. They each sold 2 of those pieces and received $115 from their customers. But because Firm 2 chose to report its operations in such a way as to yield positive net income, they are left footing a tax bill that Firm does not. We can see this in the other expenses line in the income statement, right here and right here. Wow, that was really tricky, Dave. Yes, it was. But it serves a very important purpose, and I begin every course that I teach with this same example. There are a couple of lessons that can be learned from it. First, we see that people use financial statement information to make important decisions that impact personal wealth, whether we're talking about saving for our retirements and so looking to invest some money, or are the CEO of a corporation looking at divisional results or a possible acquisition target. The primary information source comes out of the accounting system. And that's what we did just now. We looked at the financials and said, net income, I know what that is, and gross margin. And I know what an asset is. And we cobbled together a decision. The second lesson is that we can very easily make poor decisions with that accounting information if we don't really understand the rules that produce them. The inventory manipulation I made is only one of myriad ways in which accounting choices can affect the financial statements. Now, as it happens, you didn't have all the information you needed to make the decision. Along with every set of financial statements is a ton of extra data called the footnotes. This provides information about obligations the firm has, potential lawsuits, pension plans, types of assets it has, all sorts of things that help make the tabular financial data, the balance sheet and such, more meaningful. And footnote 1 is virtually always a summary of accounting policies. So if we know to look, we can get a listing of which major accounting choices a particular firm has made. Of course, that doesn't mean we understand the implications, but at least they've told us the rules of the game, if we know to look and we know where to look. The beauty of this is that once we understand those differences, we can figure out a way to compare Firm 1 with Firm 2 on an accounting neutral basis, making it much easier to come to a better decision. With that information in hand, we could line these two sets of financial statements next to each other, and the only thing that would be different would be that $9 difference in liabilities, and that $9 difference in the expense section, and we'd be able to say, you were trying to be sneaky, but we caught you. When we get to the inventory chapter, we'll play around with this some more. But in the big picture, this is the sort of thing that I'd like you to be aware of when you finish this class. That there are these types of ambiguities and gray areas out there, and when someone says, we earned $7, we know that really means we earned $7 according to the particular set of rules we chose for our accounting policies. So what do accountants do? I stole this quote from one of the older versions of the accounting standards. Quantitative information, primarily financial in nature, right there. This means they're going to give you numbers, lots of numbers, and most of them will have dollar signs in front of them. About economic entities, that is intended to be useful in making economic decisions. And that's just what we did, didn't we? That's what my goal as an accountant is to do, to provide you, the user, with the information you need to make reasoned choices. The bulk of this class, the first 10 chapters, is focused on external reporting. So here we have our balance sheet, our income statement, our cash flow statements. And who's using this? The investors, the bankers, of course. But who else would want to read these financial statements? How about the suppliers? How about the employees? Why do suppliers want to know about financial statements? Because they want to know that they're going to get paid for the stuff they sell, right? And why would I care what the University of Maine's financial statements look like? The same reason, right? Am I going to get paid? But there's even more to it than that, isn't there? Because the university wants to say, I'm poor, I'm poor, I'm poor, and so that you can't have a raise and we have to cut your benefits. And what do those financial statements tell me? Whether they're telling the truth or if they're just trying to get better leverage for contract negotiations. Internally oriented costing data will be the last several chapters of the book. Virtually every decision we make in business is based on information that comes out of an accounting system. Virtually every one. If we want to do human resources, that's got to do with hiring and firing and personnel evaluation. If we want to hire someone, what's that decision based on? How much revenue will this new employee generate? And how much will it cost to pay them? And when I put the two together, am I better off with this person or without? Say I want to build a new factory. How do I know if that's a good idea or not? Same thing. What's it going to cost me to build and run it? How much am I going to earn from selling those products? And how do I determine how I should price my products anyways? That's based on what it costs me to make it, right? And where do those numbers all come from? The accountants. So let's talk about these financial statements. They are based on GAAP, Generally Accepted Accounting Principles. What's that all about? It's worth keeping in mind as we go through the semester that there is no natural law of accounting. Accounting is a social science, not a natural science. Take the law of gravity, for instance. 9.8 meters per second squared is how fast things fall, or don't fall, gravitized. You know what I mean. There is no natural law of accounting, however. All the rules that we have made up. We think they work pretty well, but in certain cases we don't know which is the best, so we give you a choice between 2 or 3. And in certain cases we have contradictions. So these are the generally accepted principles. These are the consensus we have come to. There's an organization called the FASB who produces these rules, but ultimately what they do is sit around in a room and say, well, what do you think? I don't know. How about we try this? And then they ask people's opinions, and then they come up with a rule. The FASB is a private entity. It's not run by the government, which means that if the FASB says this is what you should do and everybody revolts, it isn't going to work. It is, by and large, a self-policing system, and the FASB only has authority to the extent that people give it the authority. If we were a publicly traded company, our ultimate obligation for financial reporting is to the SEC. The Securities and Exchange Commission can overrule the FASB if they are so inclined, and they've done so in the past. There's a new federal agency called the Public Company Accounting Oversight Board, which is another layer of reporting bureaucracy, but ultimately it all comes out as consensus. It's interesting to note that when the FASB changes a policy, this rule has an impact on people's wealth. Say the FASB imposes a new rule that makes net income go down by 10%. Who is affected by that? The stockholders, maybe. A drop in earnings could result in a drop of stock prices. What about managers? If you're paid a bonus on net income and we change the rules by which net income is calculated, what happens to your bonus? Exactly. And you can bet this doesn't go over so well in industry. I was chatting with a member of the FASB some years ago, and he told me about a plane trip he had taken. Up in first class, people actually talk to each other instead of putting on headphones and pretending that the smelly guy next to you doesn't exist. So he was chatting with this guy next to him, and when he said, I work for the FASB, the guy got all red-faced and pointed a finger at him and said, you cost me my bonus last year. Wow, how awkward is that? Hopefully it was just a commuter flight. But the moral of the story is that these rules come out of a lengthy process for which public comment is sought, and the people writing the comments might be thinking more about their own pockets than what might be the best accounting policy. Stock options is the perfect example for this. What are stock options? They are the right to buy shares of a company at some pre-specified price, and the way we typically use them is in employee motivation. So how do they work? Say today's Daveco stock is trading at $10 per share. I give my employees options to buy the shares for $15. Are they going to exercise the options? Of course not. But they now have the incentive to come to work, be good doobies, and work hard. And if they do all that, what's likely to happen? Stock price is going to go up, say, to $20 per share. So now they can buy something for $15 that's trading on the market at $20. They get an instant $5 profit per option they hold. So that's how they work. And believe me when I say that the options have a value to them even when they aren't in the money, even when the stock price is 10 and the option price is 15. There's all sorts of complex math involved, but essentially the value is in the potential for that profit when the stock price rises. So what did we do? We gave our employees something of value to do what? To come to work, be good doobies, and work hard. If we gave our employees anything else for coming to work, what would we call it? Wages, right? Compensation, an expense. Well, for years, we completely ignored that logic, and we completely ignored the value of these options we were giving our employees on the financial statements. And then the FASB says, well, maybe we should call those expenses, because they're expenses. And what happens? Pandemonium. Dogs and cats living together. Utter chaos. Companies called their senators and said, the FASB is messing up my business. Senators called the SEC. The SEC called the FASB and said, stow it. And the project was killed. Why? Because the rule change would suddenly make them record as an expense something they'd been doing all along. And they didn't want to take the income statement hit. Recently, the FASB tried again, and this time they managed to get it pushed through. But it was dicey because all those high-tech firms had been getting away with paying their employees with them forever and didn't want to tell the shareholders what they'd been doing. So there's a little background about GAAP. Now let's talk about the financial statements. We already saw a couple of them in the introduction, the balance sheet and the income statement. The first one is the balance sheet. The balance sheet provides a list of what stuff is owned by the company and who has claims on that stuff at a particular point in time, at December 31st. This is encapsulated in the fundamental accounting equation, assets equals liabilities plus owner's equity. That's the balance in balance sheet. So what are assets? Assets is our stuff, and that's over on the left side of the equation. And the stuff we own belongs to someone. That is, there are people with claims on those assets. Some of those people are our creditors, and their claims are our liabilities. And what's ever left is claimed by the owners. For many of us in BUA 400, this should be a relatively easy thing to envision. What is my asset? It's my house. It's my house. Who owns the house? Not me, right? The bank owns the house. If we were going to create financial statements for Daveco, which is essentially just me, my balance sheet would show the asset as being my house and my mortgage as being my liability. And what do we know about the mortgage? The bank gets dibs, right? When I sell the house, they get their money back first, and if I sell it for less than the mortgage, I bring cash to closing. But now, what's the other part? It's not something you hear so often anymore, since the housing market crashed. But what do we call it when we owe less on the house than the house is worth? Do you remember those ads? Borrow against the equity in your house. And what is the equity? It was the value of the house, our asset, that exceeded the liabilities attached to it. So here we have our very basic accounting equation. The asset is claimed by the bank first, and everything else goes to me. And that's the way we're going to treat the firm as well. Our assets are always going to be claimed first by our creditors, with the shareholders getting whatever's left. It won't always be as cut and dry as the house with a mortgage, but the idea is the same. The bills all have to get paid before the shareholders can cash out. So let's take a look at a couple of transactions that we can do to see how they affect this equation. 1. We buy inventory for cash. Well, what did we do? We got some inventory, right? And inventory is stuff. So we have an asset going up. And how did we pay for it? With cash. And cash is also stuff. So we have an asset going down. So there we see a very simple transaction, one completely held on the left side of our equation. The important thing to remember is that no matter what, we always have to keep this in balance. Someone once asked me, so Dave, by how much is the balance sheet allowed to be off and still be okay? 0. Because otherwise it wouldn't be the balance sheet anymore. If the balance sheet is ever out of whack, we did something wrong. So say we bought a truck on credit. We just got stuff, right? That truck is stuff, and we know that stuff is an asset, so our assets just went up. But how did we pay for it? Aha! We didn't. We swiped our credit card because we've got a high limit. Dave married a doctor. So we got a loan. But what if we wanted to go and sell that truck right away? What would we have to do with the money I got from it? Pay back the bank, right? So right now, I owe someone some money. They have a claim on the assets of the firm. What do we call that? A liability. Our liabilities go up, and again, the equation is in balance. Now, let's pay off the debt. What's happened? Well, we no longer owe the bank any money, right? So that liability that we've got sitting over here has to go away. But how did we make it go away? By writing a check and pulling the cash out of our bank account. And what is cash? Stuff, an asset. So our asset goes down as well, and the equation remains in balance. Okay, next. We provide a service and get paid cash. Well, obviously we have more cash, and cash is an asset, so there's our asset going up. But how do we balance this equation? Well, let's think this through. Do we have less of an asset? That would balance the equation. Nope. We didn't give up anything other than the time we spent. How about a liability? Do we owe anything to anyone? Nope. We did the work and they paid us for it, and that's that. So what's left? Equity has to go up. Now, does that make sense to us? Well, let's put it in context. Say I mow my neighbor's lawn. I don't really. I hate mowing my own lawn. I'm not going to mow my neighbor's. But humor me for a moment. I mow my neighbor's lawn and they give me 20 bucks. Whose money is that? Who has a claim on it? Me. That money all belongs to me. So here we have an increase in the firm equity. The owners of the firm, in this case me, are wealthier than they were before because of this transaction. And of course, this is the whole point of the business, to create value for the shareholders, and we record that value in equity. Last one, we get paid today for work we're going to do in the future. Cash has come in, cash is an asset goes up, good. But what about the other side? Whose money is that? True, it's in our bank account, but who has a claim on that money? The customer does, doesn't he? Why did he give us the money? So we would do work. But what if we decide not to do the work? We have to give him the money back, don't we? So while the cash is in our possession, the owners have no claim on it until we've done the work. The liability, rather than the equity, has gone up. So there's our balance sheet. We'll come back and spend some more time with this next class. Our second biggie is the income statement. And what is the goal of the income statement? It's to show the performance of the firm over time. From the beginning of the period to the end of the period, how much money did we make? Recall that the balance sheet was a snapshot. It was as of. With the rest of our statements, including the income statement, these are flow statements for the period ended. How much did we generate? Most of what we do as accountants is focused around measuring items on the income statement. How much revenue we earned, and how much expense was incurred, and so on. So what is a revenue? A revenue is an increase or in asset or decrease in liabilities due to the profit-oriented operations of the firm. Either one works. We saw above that we had a revenue in which we were paid cash for our lawn mowing. There's an increase in the asset. We also saw above that if we were paid in advance, we called it a liability. What happens when we actually do the work? We no longer owe our customer as much work as we did before. So there we see the decrease in the liability associated with revenue generation. Expenses, on the other hand, are decreases in assets or increases in liabilities due to those same profit-oriented operations. These are the costs of generating revenues. I mow the lawn, I have to pay for gas. I'm a law firm, I have to pay my associates and my paralegals to do research. That's what we call an expense, a cost of generating revenue. And again, it could affect the asset or the liability side. If we pay our employees cash, there's a decrease in the asset. But what about that light bill? If we use electricity today to generate revenue, but we aren't paying cash, there's no meter we drop quarters into. They just send us a bill. We have used their electricity. We owe them for the electricity, but we haven't paid them yet. There we have a liability going up with the expense recognition. We saw a couple of income statements before, and I've reproduced them here. What do we see? We see sales, minus cost of goods sold gives us gross profit, minus our other expenses gives us a net loss, and we'll put two little lines down there because we're good little accountants. We'll see next class that these things can become beastly large, line after line after line of detail. Pay attention to these things. If you're ever looking at a set of financial statements and you say, geez, there's a lot of stuff here, it's not because we like doing it, though I do like doing it. It's because it's information, decision-useful information that we can use to make informed choices. Ultimately, we are driving toward net income, which is theoretically the wealth created by the firm during the current period. But we can see, just by setting these two guys next to each other, that it's not quite as simple as that. Same firm, same transactions, different net incomes. So we have the cash flow statement next. And the statement of cash flow takes a look at the exact same thing. We've just spent the year doing stuff. How'd we do? The income statement comes to a number called net income. The cash flow statement comes to a number that says net cash flow. It's two different ways of looking at the same thing. You'll note that the statement of cash flow is broken into three chunks: operating, investing, and financing. I like to draw a little picture here for the cash flow statement to put its structure into the context. The business is like an apple tree. And here's an apple, and here's an apple, and here's an apple. The business is like an apple tree. A very happy little apple tree. The tree has roots in the ground where it pulls in the nutrients and water and such that it needs. That's the financing activities of the firm. That's where we get our seed capital, if you will. And no, they don't get any better. And what do we do with that money? We invest it in buildings, in cars, in machinery. That's the infrastructure. That's the infrastructure much like the infrastructure of the tree, the trunk and the branches and stuff. And everything is driving towards that top part, the operations of the business. The tree uses its infrastructure to grow leaves and photosynthesize and stuff, and to make apples. Our business uses its infrastructure to provide goods and services to the customer. Now you might be saying to yourself, yeah, Dave, I see that, but why so much work? I could look at last year's balance sheet and this year's balance sheet and see that cash changed by $288, and I could skip all the rest of that stuff. And the answer is the answer that I'll give whenever we wonder about the complexity of some of our reporting rules. Because it matters. Because simply knowing that cash went up isn't good enough. We should want to know, why did cash go up? Did it go up because we borrowed more money from the bank down here in financing? Or did it go up because we were profitable this year, because we bought and sold product for more than we sold product for more than we bought it? Those are two very different sources of cash, and if we want to make a good decision, we should pay attention to that sort of distinction. Our last statement is a statement of shareholders' equity, or stockholders' equity, or owner's equity. If this were a partnership, we'd call it a statement of partners' capital. What we call it doesn't really matter. But what it is a roll forward of beginning balance to ending balance of all our equity accounts. If we issued stock, it would be here. Net income would be here. Dividends would be in here. There's our stock, affecting the stock account. There's our income. There's our dividend. Now, one caution for you. The book says that this is typically perceived as being the least useful of financial statements. And while technically true, it's like saying your spleen is the least important internal organ. We could live without it, but do we really want to? Because there are things that affect shareholder wealth and shareholder equity, but don't show up on the income statement on purpose. An example of this would be if we bought shares of Bobco stock for $1,000. And at the end of the year, Bobco's stock is now only $700 because Bobco is a pig. Crap! We're sad, right? We spent $1,000 on an asset that lost value. That $300 loss probably won't show up on the income statement, though, until we actually sell the stock. But we are $300 poorer, aren't we? We would see that in a separate column on this statement right over here. If we were hedging, doing funky derivative stuff, doing foreign currency stuff, many of the gains and losses associated with those get pushed here as well, again, bypassing the income statement. These are real changes in shareholder wealth that are excluded from the income statement by design. Of course, I already mentioned the footnotes to you. For a typical set of financial statements, there might be 4 or 5 pages of this tabular data we were just looking at, and another 20 of footnotes. Much of the meat and detail can be found in those footnotes, so make sure you don't ignore them. So that is a brief introduction and overview of the financial statements. Next class, we will back up a bit and set the groundwork for what financial statements are designed to do and how we get them to fill that purpose. We will also take a deeper look at a real balance sheet and income statement and get an understanding of what all the lines on them really mean.